Hi, my name is Ed D'Agostino, and today I'm joined by two financial analysts and best-selling authors, John Mauldin and Harry Dent. We'll be discussing what's going on in the world's major economies with regard to demographics and debt, and how you can benefit from these trends and avoid the pitfalls. Harry Dent is an expert in the field of demographics, which he uses to predict behaviors and consequently economic activity. John Mauldin has written extensively about the dangers of rising government debt loads and the inevitable outcome of too much debt. We'll look at the US, Europe, Japan, and China, and we'll wrap up with their suggestions on how to invest accordingly. Gentlemen, thank you for joining me.
Good to be here. Yeah. Good to be with
Hi,
Harry.
John.
Let's start with Harry, and we're going to start with the United States. So, Harry, everybody, of course, knows the term the baby boomers. But I think a lot of people miss the impact that the baby boomers heading into retirement is having on this country. Do you agree?
Yeah, I mean, every effect. A pig moving to a python, they said from the beginning. This generation is supersized compared. You have to go back 250 years to find a generation with this much impact. So they created the great inflation when they were young. And then they created the great boom. From 83 to 2007 is literally a 46-year lag for the peak in spending of the average person on the baby boom's rising trend into the workforce, get married, buy houses, borrow money. They also created the greatest debt bubble in history around the world. But the baby boom peaked in 2007. We predicted this 20 years ago, that the top number of baby boomers would hit their peak in spending and the momentum would shift down, which it does every 39 to 40 years. The 1970s was difficult, and the 30s. So we have a difficult economy ahead of us, and it's taking all this massive stimulus. I calculate about $2 trillion a year between fiscal and monetary on average. $2 trillion a year just to get, 2% growth in the economy, $350 billion. That's a bad deal. That shows how much the weighing of debt and the aging of the baby boomers, and it only gets worse. That's the thing. Right. The upper class peaks later than 46, about age 52 to 54. That's going to hit. The people that are still spending money and benefiting from the stimulus, that's going to hit in the next year or two. So governments around the world, and in the United States included, is going to find that there's not enough stimulus to keep this thing going. You're fighting demographic and debt trends that are too strong downward, and they're global.
So that's the demographic side of the U.S. John, let's talk about debt. U.S. debt load continues to grow. How is that going to impact our economy over the next, say, 5, 6, 7 years?
Well, we all know that we can't spend $200 trillion on healthcare over the next 30, 40 years. It's not going to happen. So the question is, what happens when we realize it can't happen? That will happen in the next few years. Either that or in 3 or 4 years, the markets will force us to make it happen. But one way or another, we're going to make a decision.
The bond markets?
The bond markets. But that becomes another deleveraging force right along with demographics, because we're really going to have to reduce the amount of deficit and debt that's going into the economy. We have to rationalize our healthcare system one way or the other. We have to rationalize our tax system one way or the other. That's actually quite a good thing if we do it correctly when we get on the other side of it. It's the process of doing it is going to be difficult and sloppy. But even with that and doing it correctly, we're in a muddle-through economy probably for the rest of this decade. And the good news is the secular bear market's getting long in the tooth. One more correction, one more issue, and we're probably setting ourselves up now for another good trend. I get to turn bullish about even the stock markets in the world. But the human experiment is a growing positive thing.
So you're not too concerned about debt in the U.S.?
I'm very concerned about debt. That is the issue. The number one thing we should be worried about in the United States is how do we deal with our deficits and debt? And that really revolves around health care. How much health care do we want as a country, and how do we want to pay for it?
And given that the biggest living generation is moving into the highest need for health care, that's a serious
They're going to
problem.
make this a more and more serious problem until we have to face it. And the problem is when we do, like you said, Johnson, it's deleveraging at first. It's only going to slow growth. But as Thomas Friedman says, if we don't have a difficult decade, we're going to have a challenging century. If we do not deal with this health care and this massive debt, I look back at history at bubbles, debt bubbles, financial bubbles. I can't even compare past bubbles like in 1929 to this. Our debt, private debt, is more than double what is in the past. Government debt, way higher. It's just, this is massive. And again, these entitlements, we didn't have entitlements in the last time bubble. We didn't have Social Security and health care. And that's 67 trillion of unfunded and rising debt. So we have to deal with this, and nobody wants to deal with it because no central banker or politician wants to deleverage on their watch because it's going to look like the 30s and it's going to be deflationary. It's going to be ugly.
So do we move to a European-style model for healthcare? Is that a better outcome for us?
No,
Well,
no.
what do you think about Europe right now?
Europe's got its own problems. In fact, Europe is going to be, I think, in a far worse situation. I think Harry
They're
would,
aging faster, no
Harry would
question.
agree with me. Demographically, they're in a worse situation. Financially, budget-wise, much of Southern Europe, France especially, France is going to be the key next year. Europe is going to have its final come to Jesus moment when the French hit their deficit wall. Yeah. And they're going to have to make a decision whether they want to become a fiscal union or they want to have two monetary unions and a trade union, free trade zone. I mean, they're going to have to figure something out.
Are the demographics the same across all of Europe, or is there
No,
are there
no.
weighted
The
areas?
Scandinavian countries are the best, and then France, surprisingly.
Yes.
And then England. Germany, Austria, and Switzerland, the bulwarks, have
drivers
the
of the-
fastest declining demographics. Those countries, including England, are going to fall off what I call the demographic cliff that we fell off in 2008 and Japan back in 1996 and 7. They're going to fall off this cliff. They're already in trouble, and they haven't hit the worst demographic trends yet. And these are the strong countries. All of Southern Europe has horrible demographics for decades to come. So Japan, East Asia, Southern and Central Europe are the fastest aging parts of the world.
The United States should take advantage of the one thing we have, which is the rest of the world wants to come live here. Yeah, and we should be giving not just green cards to everybody that graduates from our universities. We should be putting signs out. If you're young, if you have some modicum of English and you got a degree, come to the United States at every one of our embassies.
Right.
It's the one thing we turn away, is the highly skilled.
Yeah,
we let everybody else run across the border.
We need educated young people. And if you've got money, we think we ought to, we need to actually be, if you talk about stimulus, there's stimulus, young, educated, and especially young, rich, educated people. We should just, come on in.
But
That's a stimulus.
What about Japan? Let's talk about Japan for a minute. Demographics in Japan are, I would imagine, awful at this point.
That's the fastest aging country in the world. Their baby boom peaked between 42 and 49, both sides of World War II, and that caused a double peak in their kind of stocks and economy late 89 and 96. Ever since late 96, despite QE forever, they have gone into a coma economy. They have had zero GDP growth, actually slightly negative for the last 17 years, zero inflation, slightly negative, slightly deflationary, and they go in and out of that. And that's despite QE. So they're proving QE does not pull you out of this long term. It just keeps you in a coma. You never have the crisis, the deleveraging, the entitlement crisis you need to have to get real. So you keep carrying these burdens while what? Your population gets older and older. How the hell are they going to produce anything when everybody's 80, 90 years old there?
Well, and the research that came out at Jackson Hole, you've now seen two recent major Fed papers saying quantitative easing doesn't work. And what does work is forward guidance. So they're going to give us forward guidance on low rates to 2017, maybe beyond. They're going to change the way they pay interest on their reserves. They're still trying to figure out how to tinker with what is a deleveraging and demographic problem and a debt problem. When we deal with that in a rational, realistic way, the problem will kind of magically disappear over
I don't
a few
think we
years.
will. I don't think we will do it without a
Well-
crisis. And I think the crisis is going to come not from the U.S. We started the last crisis, the subprime crisis, and our baby boom dip. I think it's going to come from Southern Europe, and France, places like that, and from China, who's got the greatest bubble and the greatest overbuilding by governments, oversteering and over-manipulating an economy ever in history. Either those things blow, and then we go into a crisis, and then we get real about debt. We got much more private debt than we have government debt. If you take out healthcare. The private debt, you could restructure $42 trillion at the peak in 2008 down to $20 trillion just to pre-bubble levels, just to go back to 2000 when we had the incredible debt bubble. That would take $1.5 trillion principal and interest off of the private sector. No longer giving money just to banks or governments or agencies. You write down loans for the private sector. I wouldn't give banks a nickel if I was the Treasury or the central banks. I would only give them money on a ratio, maybe 25 cents a dollar for every dollar they wrote down in
How do you
private debt.
maintain a viable banking system if the entire private sector is deleveraging? Someone's going to take a
It's
haircut.
messy. That's what the 30s was about. It was a big debt detox. But 3 years, we went from like 190% debt to GDP total down to 50%. We got rid of a lot of debt forever. It's worth some difficulty for that.
The U.S. banks are in much better shape than they were pre-crisis.
Well, they've
in
got
terms of their
trillions
leverage.
of
Well, they have. They've
free
been
reserves
they've
of
been-
money. Of course
they've
they
been-
are.
They've been bailed out, but we need to shrink the big five, cut them up,
Slice
increase
them,
their
dice
capital, but restructure things so they actually go back to old-fashioned banking. Europe's
Yeah, banks should be banks. Investment banks should be
yeah.
investment banks.
Europe's banks, some of the European banks are in serious
much more.
serious kimchi. And that will be part of their crisis when they start having it, that they're all going to have to, I mean, they've got to either become a fiscal union or figure out 2 years.
Yeah.
They've got to do something.
So we're really at risk of a European Lehman moment of sorts.
Yeah, I think that we're going to get a crisis from the outside. The rest of the world got our crisis from the outside. I think we've got the most consistent monetary policy. I still think it's ridiculous. QE should not be a long-term policy. It should be short-term liquidity. When you got a crisis, you don't want to just mushroom. But you don't do this for 5 years. I don't even think you hold interest rates.
Well, that's
down
what my
that long.
book Code Red was about, was that the problem is they put the patient on morphine.
Yeah.
And they haven't taken them off. Normally you've come in, you bring the patient in, you stabilize it. That's what central banks should do. But now they're trying to manipulate the economy. We have 12 people sitting around saying, we can fine-tune an economy. They can't.
You know what they're really doing, John? They created the greatest bubble in history. Baby boomers, banks, governments, everybody. And now you know what the policy is? We'll just keep it going forever. How insane is that? That is impossible to keep a bubble going forever.
Well,
that's what they're trying to do. They're trying to keep the bubble going.
You have to allow systems to correct.
Yeah.
And
Rebalance.
those corrections are part of the process, and small corrections that are stalled, that are not allowed to happen, mean that you have a big correction when it happens.
That's what happened after the Fed was created in 1913. They smoothed out the cycle, and then we got the greatest depression ever from not letting the economy ever rebalance.
So will it happen? Do you think that one way or another we have to have a correction, whether we figure
I
it
think
out
we're
on
going to
our
have
own?
a big crisis, and it's not going to be because of government action. It's going to be because they keep pumping this thing up, something pops the balloon, and then it implodes, and then we're in a crisis, and then we get clear. I mean, people, when the barn's burning, they run in and save the horse and the dog and bring out the baby. People become heroes. But right now, everybody's kicking this can down the road.
I hope we're smarter than that. If we're not, Harry just laughing
luck,
at me.
John.
And, you know, and
What have we shown so far?
a lot of
Not at
people,
all.
when they, you know, I keep telling people I'm an irrational optimist. They keep calling me a bear, but I'm not. I hope that we can look at the crisis that's going to happen in Europe, look at what's going to happen in Japan and say, we don't want to become that. We need to solve it. And we're going to have the luxury of watching Europe have a true come to Jesus moment. Maybe we can take advantage of that. Maybe we're seeing that there has to be another path, that government might not be the answer. whether it's Obamacare or quantitative easing, I think those policies are going to be demonstrated as not being viable, and we can then shift and allow the human process, ingenuity, technology.
People innovate in crisis. The greatest innovations
they-
occurred in the 30s and the 1970s when there was inflation and deflation.
Harry,
the economy was bad.
we innovate in good
We're
times and bad
preventing.
times.
No, we innovate way more in bad
Well,
times. Just like the people going in and saving the horse in the
Okay,
barn.
Necessity is the mother
Yeah.
of innovation and invention. But there's this boom, this technological boom. I mean, I am really optimistic. I think the answer to our demographic issues, I would become really moribund and concerned about the demographics in the U.S. and the future of the world.
If not for
Except that technology
Yeah,
is going to allow
biotech's
our people to
coming.
live. We're going to live a
Yeah,
lot
we're gonna live
longer.
longer, yeah.
Now, you don't want to.
And we haven't seen that yet, though.
You know,
So-
I mean,
so
so we're going to live longer, and we're starting to see it, and we're going to see it more.
Yeah.
This generation is going to break the deal with past generations. We've always said we'll die at a statistically valid period of time. And this generation is going to break the deal. We're not going to die on time. We're going to live longer, and we're going to work longer, and it's going to cause a lot of adjustments throughout the economy.
Right.
But those are going to be
Difficult at
good
first.
ones.
So is
Difficult
that-
at first, but good in the
Because
long
the young
term.
people won't be able to get jobs if the baby boomers stay in the workforce forever, which they're going to have to do.
Is that a sector that you would, because I want to make sure we leave our viewers with a couple of actionable ideas. Is that a sector that the two of you would invest in?
Okay, biotech would be one of my top when we see the next crash.
Okay,
Because
so not
tech
yet.
stocks go down more than anybody. I'm into shorting stocks a little ahead, probably first quarter next year. I don't think we've quite topped here in this bubble again. And Janet Yellen says we don't have a bubble, so who am I to argue with her? You know. And I would the U.S. dollar.
She's so good at spotting
I'm
them.
I'm into protecting assets, and the U.S. dollar relative to other currencies when we actually had the last crisis did the best. So UUP is an ETF to play that. RWM is shorting the Russell 2000 with no leverage, and small caps go down faster. So those are the two ways. I'd be more into how do I make money on the downturn, because I think we've bubbled back up again, and it's time to get safe and protect your capital or bet on things going down. Now when things crash, new technology, biotech be the first place I'd go.
So U.S. dollar,
Healthcare, medical devices.
short stocks, but not quite yet. Maybe
quite yet.
Q1
Maybe January or
2014,
so, yeah.
and then after the burst, technology.
which
John,
probably take 2 years.
what do you like right now?
For a trade, I'm short the yen.
Short the end.
Harry and I are going to, after this, go look at my new apartment. It's just about ready sometime this weekend. I'm going to move in, and then I'll be able to consolidate all of the two-apartment loans, the construction loan, and I'm going to swap it all into yen. I'm going to let Kuroda-san and Abe pay for half my apartment over the next decade. I firmly believe that. Now, if I'm wrong, my apartment's going to cost me extra, but that is one trade. I want to take advantage of what the new Federal Reserve policy of they're going to give us the forward guidance, and they're going to hold rates lower for 4 years. Okay.
So a little leverage for your investments.
Little leverage with safe fixed income. I want value. I want income. Cash is a good cash. Don't think of cash as as something doing nothing. Think of cash as an option. People go out and purchase options because they think it's going to become more valuable. Your cash is an option to be able to buy stuff when we have the next crash.
If you don't have the cash, nobody's going to
Sure,
give it.
there's no opportunity if you can't take advantage of it.
And cash and income are going to be
So
paramount.
short the yen.
I agree with Harry.
cash.
Long the dollar.
And then again, after post-crash, technology.
I'm a technology, robotics and automation, biotech, nanotech. There's so much positive about the human experiment. And right now, we're seeing bubbles burst here and there. There's markets places all around the world, not just in the U.S. Don't be such a homebody.
Yeah.
There are places where people don't want to be in real countries with real businesses whose valuations are cheap.
So get out of the U.S. a little bit.
Well, you should be
For now.
You should be out of. You should be diversifying around the global growth is now a global process. It's not just a U.S. or a
Yeah, and so is technological innovation.
yes. I mean, there's opportunities everywhere.
You heard it. Technology will save the day. Harry Dent, John Malden, thank you so much for joining me. This was a real pleasure. As always, do your own due diligence before investing. Both Harry and John produce new research each week, helping thousands of investors. So sign up for Thoughts from the Frontline from John Malden and Survive and Prosper from Harry Dent today to stay up to date on demographics, debt, and much more. Thanks for watching.